All right. Excited for my guest today. I've got Rick Pederson on the Investor Podcast. He's the Vice Chairman and Chief Strategy Officer at Bow River Capital, where he leads firm-wide strategic initiatives and chairs the limited partner advisory boards across all investment funds. A seasoned institutional investor, he previously served as the president of Foundation Properties and founded Ross Consulting Group, advising Fortune 100 companies on capital asset financing and strategy. Earlier in his career, he worked with the Boston consultancy Harbridge House. Pederson holds a BSBA, MSBA, and JD degrees from the University of Denver and has served on numerous investment and civic boards, including ALPS ETF Trust, SBH/CI mutual funds, Principal Real Estate Income Fund, and the Boettcher Foundation. So, Rick, thank you for coming on the show. Excited to kind of talk about all things asset management, finance, institutional LP relationship building. Happy to kind of really take this where we want to take it. But, Rick, why don't we start with learning more about who Rick is? Tell me a little bit about kind of your early childhood. What did your parents do? Reflecting on kind of what you thought you would do kind of in high school, heading up to college. And then, if there were any career pivots, that's great. And if there were not, that's great too. Some people just know they want to, get into institutional asset management when they're in high school. I had no idea what asset management was. I was told to be an engineer or a doctor. So I learned about it later on in my career. So excited to hear your take on this. So, I'll let you kind of kick this off, and then we'll just riff off of, where you kick off.
Well, Joel, you remind me, thanks first of all, for having me on, but you remind me to say that not only did I know what asset management was, I didn't even know what business was. When I came out of high school, I was a good student and had the fortune of being offered a number of scholarships, and most of them were headed toward business school. And I remember going to my tennis coach in high school and saying, "Tell me, what is business?" And I think about that question. It was a more difficult question than perhaps I thought of at the time. But anyway, I did go a business route with really no intention of landing anywhere. And I think that is important. My career has not been necessarily goal oriented in the long run. It's been very much opportunistic in the short run. And that is my advice to young people today is do not make the perfect decision early on, because that the circumstances change, and your career path is likely to do that as well. But as you read off that string of degrees, yes, I have 3 degrees. Part of that was confusion. Part of that was curiosity. I was interested in business. I was interested in law. But what I became very interested in is really the idea of problem solving and what it takes to solve problems. And so law school taught me research, taught me communication. Business taught me certainly numbers. But as I entered university and then exited university, I was still not exactly sure the direction that I wanted to go. And I was concerned about that at that age, as I think a lot of young people are. And it was, for me, a perfect place to be, because frankly, in the last 40 years, I've never been exactly sure what the next step was going to be, and it's served me well.
That's amazing. And walk me through kind of what was going on in your mind as you were kind of navigating that through your early years of college, and what you thought that would kind of translate into in terms of kind of like a a formal career.
Again, Joel, I wasn't sure. I was interested in acquiring as much knowledge as I could. I outworked the competition, if you will, in many ways, in the sense of I was prepared, I studied hard, but it was not with a job in mind. It was with personal growth in mind. I assumed that a career would develop with the accumulation of this knowledge, and eventually it did. But I really stayed in my mind a bit of a generalist. I mean, I was in business school with a master's in law school. I managed to combine the two to create a joint degree at the University of Denver, which still exists today. But for me, stepping out of school and still being a bit uncertain about the trajectory, management consulting was a good place to be, because I had some sense that it would offer me wide opportunity, and it turned out that it did. It was a perfect starting place for me.
You asked me to shed some perspective on what I think, some indicators of success is. What I think consulting provides, and I think even like project management provides, is the reliance on just jumping in quickly and picking things up. So like, you're on one consulting project. If you work at, one of these big fours, you're working on like, PricewaterhouseCoopers, you may be working on a 3 to 4 month project in the logistics space. Then you got to quickly switch gears and work in the healthcare space. So one of the things that I've noticed is someone that can really jump in and pick things up really quickly. Those are the people that can stomach change. I don't think a government employee is going to be able to deal with that, right? I mean, so being able to kind of be nimble and kind of handle multiple projects, drink from the fire hose, and also handle change. We're going through a pretty crazy shift right now where, Amazon is laying off 14,000 engineers. A lot of the jobs are getting replaced with AI. So how do you handle that change, and can you navigate that to kind of figuring out what the next step is? But just my humble opinion, Rick, I don't know what your thoughts are or reaction is to my comment.
Exactly that. My definition of handling change is being invited to or forced to become an expert very quickly. And I recall my first days at Harbridge House. I was within weeks testifying before the state of New York regarding nuclear power plant sightings. Weeks after that, I was reorganizing a large energy company. What comes is broad and challenging. And what I found, interestingly, is that the more uncomfortable I was, Joel, the more comfortable I was, in the sense that if the challenge wasn't in front of me, I felt as if I wasn't productive. I wasn't learning. And so I thrived on the next assignment, the big assignment. And it wasn't personal recognition that drove me. Again, it was personal curiosity. It was knowledge acquisition. And as you say, that discomfort, that being able to quickly learn about something that you didn't know about heretofore is perhaps a fundamental part of your career, whatever you're doing, I think.
No, I totally agree. So tell me about some of the big things that you learned when you were working at, I think it was Harbridge House.
Harbridge House, yeah, it was Harvard's consulting firm in the mid-century there, and we were a McKinsey Boston Consulting Group type of firm, but we did a good deal of government work. We were designing water policy in California, for example. We were working for the Navy in some of its defense strategy, but we did a lot of corporate work as well. One of my large clients was John Deere, and we did work with them all over the nation. And I loved it, Joel. It was a terrific start for me. It taught me to be self-confident. Importantly, it taught me to communicate, as I said before, both written and oral, which is, again, a fundamental part of any career, of a successful career. But what I learned along the way at Harbridge House was something interesting, as I didn't find many consultants who were expert out there in what I'd call the hard side of balance sheets, and that became real estate. And so I was working with Bank of America and some others trying to rationalize their real estate strategy around the world. And I elected about 6 years into my Boston stint to come back to Colorado and create my own consulting company that focused just on that. And so I was carrying my comfort zone of consulting into an area that I wasn't an expert in, real estate. And in the early 80s, formed a consulting group, and it was just 2 or 3 of us. We began with local and regional real estate related issues and planning issues. And eventually that morphed into work with large companies, Fortune 100 companies, and we did some extraordinary things, Joel. We helped HP, Hewlett Packard move into China and expand them in South America. We negotiated large real estate and finance contracts with Whirlpool Corp in Australia. It was an excellent company, and we did terrific things. And as I think about all of that time, it was a period of constant discomfort. How do we become an expert not only in an asset class or in a financing structure, but also with the politics and economy of another nation? And something I learned, back to your question, is it's important to be a micro expert, understanding balance sheets, income statements, spreadsheets. But if you're not able to put that in the context of the macro environment, be it economy or tax policy or what have you, today it's immigration, tariffs, it's suboptimal. And so you have to be a micro and a macro expert simultaneously to be effective, I think.
Sure. No, absolutely. And I would say too, with consulting, you're really solving problems. I would assume, back then, we didn't have, paid media to acquire customers at scale, right? It's really through referrals and through other people kind of vouching for you. So your reputation is everything. And I feel like that cascades into the investment space as well, right? So tell me kind of what happened after that chapter of kind of doing consulting. What was kind of the next step?
Well,
and how did you make that transition?
Exactly. It was a pivot that I didn't anticipate, but I was, as I said, I was a consultant in real estate. I became arguably a real estate expert. Some of my clients were foundations who had invested in early funds with Prudential. I shouldn't say that name at the time, but a fund that was not doing well back in the late 80s. And so these investors, these not-for-profit investors, hired me to extract them from that fund. And I did that. And we were successful with it. They said, "You seem to understand this world and understand real estate. Can we invest with you?" So it was that unusual and happy circumstance where you have investors coming to you to say, "Will you advise us?" And so I created a fund, a series of funds in the 90s. You mentioned Foundation Properties. That was the name of the company. We had 3 closed-end funds. We worked with university endowments and private foundations in the region here. It was relatively small, $100 million, but we began buying real estate with them, and it was over a 20-year period, very successful.
So how has the foundation landscape evolved since, you were kind of working in that space with the real estate, projects and closed-ended funds? I see a lot of endowments now looking at open-ended funds, and then obviously endowments themselves and university endowments are open-ended. Some people say there's a difference between, clear difference between evergreen and open-ended, but many of these vehicles are, have evolved since kind of the closed-ended fund. So just in terms of like endowments and how they function and how they work with asset management firms, have you seen any kind of larger evolution from, I guess, when you were working with them?
Oh, hugely, Joel. When we formed Foundation Properties in the early 90s, I was able to literally, by referral of one foundation to another, one university to another, walk into a door and gather a group of investors. Today, that really is virtually impossible. All of these entities are represented by large consultants, and there are allocation policies. Very difficult for the advisor to win an assignment like that directly with the investor. So there are intermediaries. The allocation policies are significant. But something also occurred when we had that fund in the late 1990s. Yale University and David Swenson began investing heavily in private assets. And as a matter of fact, David, who became a friend, wrote a book called Pioneering Portfolio Management in 1999, I believe. And it was revolutionary for foundations and endowments, that it gave them permission and courage to invest in other than stocks and bonds. And it was revolutionary for me because this is exactly what I had been preaching. And so I now had a horn book, if you will, to remind my clients, my investors, that this was a proper course. And so they professionalized, if you will, to answer your question. But number two is a mindset of adding private assets, real estate, for example, to portfolios. Really, in the early 2000s, changed the landscape of investing.
No, that's really interesting. And I've seen a handful of people. I do know a few people that have worked at massive Ivy League school endowments, and then they've spun off and had a similar model. So the open-ended model has worked, and LPs is certain types of LPs like that because you can kind of continue to reinvest, and then from the fund structure standpoint, you can continue to gather new assets in kind of like an evergreen fashion versus a private closed-ended fund. Obviously, there's a portfolio construction around that, and you're really working against the deployment cycle and obviously monitoring the performance of that. So in my mind, those are kind of the two big fundamental thoughts around just both of those structures. But I think kind of working with these foundations, how can someone kind of engage with foundations in today's age? So I'm familiar with the gatekeepers that exist. So what have you seen that's worked? And, obviously what are kind of the bigger fundamental challenges besides just kind of saying, hey, you know what, I got this gatekeeper? Because the gatekeepers, they get paid to say no, essentially, right? It's more risky for their job if they do say yes, I'd assume, right?
They do.
Yeah.
And as we all know, gatekeepers will often take the safe route, and the safe route is typically to invest in the largest managers. And so Apollo Blackstone, for example, in real estate, there are dozens of others that typically see consultant recommendations. As a small advisor, it's more difficult to be noticed. Performance is going to be important, but it's not necessarily a safe route to go. But you mentioned how is foundation or endowment, or frankly any investor thinking, changing? I mean, it is moving to more of an open concept to some extent, but private assets are not all the same. Easy to say. And real estate tends to move in cycles. Product types tend to move in their own cycles within it, different than private equity, different than software, and so you can't just say, I'm going to invest in private assets. You have to pick a class, and then you have to pick a strategy within that. Seems easy, but it's actually it's complex, and working one product type against another is important. I think we are going to see much more real estate open-ended kind of thinking. Evergreen is certainly moving into everything. And as you know, you met Jeremy Held. We are in evergreen with co-investments and secondary positions with private equity. We are considering right now the same in real estate. But a perpetual type of investment in real estate must rely on income in the long run. I've been in real estate a long time. There are two ways to make money in real estate. In the very short term, capital appreciation. In the longer term, income plus capital appreciation. And so you have to, what the problem with closed-end funds, especially in a PE model of 5 or 7 year holds, is you can do okay, but you may miss a market cycle on the capital appreciation side. Real estate in the last 20 years has become very interested in cap rate compression and making the most money it can. At the end of the day, real estate is fundamentally an income proxy. And so I think real estate is probably best either in a very short, targeted, what I would call rifle shot approach, 2 to 3 years, taking advantage of dislocation or some distress, or long-term income. But sometimes 7 and 10 year strategies in real estate just don't work.
Yeah, just the multiples don't make sense, right? I mean, you don't get the same type of, if you're going to, be sitting on something for 7 and 10 years, you might as well do venture and then kind of, get some type of liquidity from a secondary, because companies don't stay, companies don't exit within 7 to 10 years these days, right? I mean, SpaceX may be having an IPO soon, but we'll see. But what's that valuation, right? So, I mean, people could essentially, some of these companies, I wouldn't be surprised, would be still private for, 10 to 14 years,
And more of the public side is moving to private for good reasons as well. Yeah. I mean, I have fended off criticism, inquiry about private asset valuation, opacity. We're certainly, Bow River and all of our brethren have not seen the distributions that we're typically seeing in the last several years coming out of COVID. But we are very proud of our valuation policy. And even though we don't price every day like the stock market does, our analysis, our backup to valuation is good. And I think it's proven in a company like ours that sells assets every few years. If you're selling close to your mark, your valuations are roughly right. You shouldn't be surprising your investors either on the upside or the downside.
No, I totally agree. And I'll say this too. I mean, some of these companies, I mean, I wouldn't be surprised if they outlasted the fund life. Like there was a hypersonic jet company that I looked at years ago, and they were telling me that it was going to take 14 years for it to kind of come to commercial. That's like 2 fund cycles, if you really think about it. So that's kind of the bigger risk. But if there is liquidity opportunities, and I mean, there's risks going really early, but then there's also risks going really late, because you don't know what the price will actually be when there is an IPO, right? You might actually, the IPO may be lower than the price point that you got in.
Yeah, exactly.
There was a down round.
And when you have investors interested in distributions like they are now, it influences you to potentially sell to someone else who may make money, and that's fine. I mean, as you say, the success of many of our holdings goes far beyond our holding period, and we're fine with that. We do well, our investors do well, and frankly, the buyers do well also. That's the course. But as you say, not only does opportunity and upside increase over time, but risk does as well. And
I was going to say, many of the institutional LPs that I've spoken to, they haven't been as happy with the bigger franchises, right? If you invest in some of these bigger tier 1 funds, these mega funds, you're not going to get the same cash on cash return, because it's just a function of essentially proportions, right? So if you've got a smaller fund, your multiple is going to be much bigger than just a bigger fund, because just a bigger scale fund, you're not going to get that type of multiple, in my opinion. And then I think that another interesting insight was there was pretty large institutional LP that I know that only invests in fund 3s, because that fund 3 is really where they start seeing a little bit of DPI. Right. So I thought that was kind of an interesting insight as well. So I don't know, if you have any additional tack on comments to or reactions in terms of kind of the LP perspective. And I think that dovetails in perfectly to your role as chairing the limited partner advisory boards across, many of these funds.
Yeah, you mentioned that many investors, certainly large investors, will not invest certainly in fund 1s of an advisor. And I understand that and don't disagree with it. There are many advisors out there unpracticed, and before I invest in them, I want to see their process. I want to see their performance, and I want to see that it's repeatable, which is a word that we see often in our industry. And so if I can show fund 1 and fund 2 and the types of investments, the methodology of operations, and the performance is similar, doesn't have to be identical, but similar, I'm much more comfortable going into a fund 3. And so I tend to agree that you need to understand manager competence, and it takes a couple of funds to do that. And so we're now into fund 3s and 4s, and I would say that our reputation, our recognition is moving up substantially. Part of that is our size, but part of it is really consistency of performance, and it's also self-serving, but it's top tier performance. I mean, there is a huge difference in top decile and bottom decile performance in private assets, and we happen to be in the former, and that gets attention. So that's good.
Yeah. On
you
the
would ask,
contrary, oh, go ahead. Sorry, Ray. Go ahead.
I'm happy to talk about what I do at
Yeah,
Bow
let's
River.
do it. Yeah, let's do it.
Our company, now 24 years old, Denver-based, is a private asset alternative investor. And we began with private equity, and over the years, we've expanded that to two credit platforms, to software growth, real estate. We have an evergreen product. And so we are heavy into all sorts of alternative assets. For each of those, we build teams around them. But very importantly, Joel, my job in part is to make certain that these groups of experts in these product types and these asset types are talking with one another. And so we believe that there's a good deal of value for our evergreen fund when they're looking at something in technology to be able to talk to our technology group. All of our private equity industrials have real estate related concerns. They talk to our real estate people, even have them negotiate leases for them, or potentially a purchase of a building. And so there's a lot of cross in that. And that is a good deal of what I think makes a company like ours successful, is that cross-fertilization, that communication. My job as Chief Strategy Officer is number one, to deal with problems that we have, and maybe more importantly, Joel, to prevent problems that we don't have. I may look young on screen, but I've got a lot of experience, and so there's not very much that I haven't seen, and so I'm always trying to look ahead, both at the micro situation, but also, as we talked about, the macro situation. I'm very interested in what the economic growth projections are, what interest rates may do, advising on our debt to equity structures in all of our assets. And so I try to have some fingers on that. It's a great place to be, and it allows me to kind of move back and forth between the assets to be valuable where I need to be.
That's amazing. Yeah, the only thing I was going to say is there is a whole community of LPs that are seeding managers, and they're coming in really early, because based on some of the data, some of these emerging managers, coming. I mean, this was back in the day. If you think about the Tiger Cubs, right? I mean, Tiger Asset Management, they used to seed all these managers, these hedge funds, and then some of these top tier funds have come out of that Tiger program. So I think a big thing is kind of you have this chair role where you're kind of advising all these funds, and you're pretty much creating like a mind hive, right? There's all these managers that are kind of supporting each other. There's maybe one manager that focuses on high growth software. You could probably connect them to someone that's kind of been through your program or your cohort. So there's a lot of these GP seeders now that are coming in. Some of them do take a portion of the carry, and there's really great revenue that can come from that, right? If you got a piece of the carry, plus you got a piece of the management fee, over time, you're essentially owning a stake of the business, right? So that GP stakes approach is really interesting. And then there was a program that was launched by, I think it was Sundana Capital a few years ago. They had this whole nano fund program. There's a lot of these entrepreneurs that have exited, and they have a huge ecosystem of other founders, and they just don't have the fund yet because they just exited. But they'll anchor a little bit of their own fund, and they've just built a huge network from that exit, right? So then there's other LPs that hear about it, and they'll come in. Just historically, if you look at the data, right? I mean, some of these emerging managers, sub 50 million and less, some of them have produced like a 5x cash on cash. And the benefit of getting in early is, you're that day one LP, right? You came in the early days, you got to know them, you built a relationship with them. You're kind of paving the stones for the fund twos and the fund threes, maybe with preferential terms as well, to get early access. So that's just kind of the contrary with not having the track record. You got to start somewhere, right? Steven Schwartzman started, I mean, I don't know if you read his book, but I think he started the book with, I think it was like his small $10 million fund, and he went to the Harvard endowment and it was raining. And I think they flaked on him, right? So what's your reaction to that new manager, that new breakthrough manager? What advice would you give that manager just getting started with no track record, no pedigree? They're just like day one, deciding that they want to build something.
Well, I would argue that every good investor has some pedigree, some track record. I mean, you
Yeah,
don't come out of college and just start a fund, or you shouldn't. I don't think you should do
sure.
some single asset investing. Develop that track record early. Demonstrate that
Yeah,
you are indeed a good investor, because not everyone is. I think it's very healthy for these larger investors to come in to seed a general partner condition. I think it does accelerate the growth of certain advisors. Of course, there
yeah,
is risk in that. You're
sure.
betting. I said just a minute ago that a lot of investors won't invest until fund 2 or 3. This is sort of the reciprocal of that, is you're investing before fund 1 and coming
Yeah,
into it. Now, you deserve to be paid well if it does well, but you're investing in not a track record of an entity, but really the track record of the individuals. And
yeah.
so that you have to build what you can in that as best you can. But we've all invested in something, whether it's homes or with our families. And so you're building a track record by doing that. Be mindful of how you do it in terms of your sort of product selection, your investment process, your discipline around operations, and managing that asset. And you do that one time, you've begun a track record. So I'm all in favor of small manager acceleration,
hmm
and I'm all in favor of bringing young investors to the fore. It doesn't need to be a big firm model at all,
hmm
but it does come with a certain amount of risk.
Yeah, no, you make a good point, and I think you hit on something that I think is interesting, where everyone has the right and ability to create their own track record and their own pedigree. And a pedigree doesn't need to be that you went to, you graduated from Harvard and you grew up in the country club, but maybe you cut your teeth in consulting, maybe you cut your teeth working at a high growth startup, and that turned into something. And then maybe, and to your point, like I always advise to do a few small investments and kind of create some type of synthetic track record, right? Whether it's a series of small angel investments, and then you can kind of cobble together showing that there's markups across the board on half of them, right? And they showcase, kind of a higher signaling in terms of like a positive direction. And also, I think it's good to talk through what you learned from maybe the deals that didn't go through well, and have that be part of your narrative as you're kind of presenting and going out to market as well.
Very, very important point.
Mm-hmm.
I think the culture of an investment firm is born certainly first from success.
Mm-hmm.
You understand what you did and why you did it, and that on the platform of that performance, you can celebrate that win as long as you understand why you won.
Mm-hmm.
But nothing more important to building the strength and culture of a firm, I think, than I'll call it failure. Some adversity, an investment that doesn't go right, it took too long, it didn't perform as you wanted. That's, if I'm a limited partner, I'm going to look at that point. Just as you say,
Mm-hmm.
what happened in the investment that didn't work? How did that happen? Was it choice of investment? Was it how it was managed? Was it
Mm-hmm.
external market factors? But I want to gauge the strength, the competence of a manager based upon how they do when they don't do well. And so that's
Yeah.
what I think you're doing as a young advisor, is training yourself to understand what you're doing and why something worked, and how you reacted, how you responded when it didn't work. You're
Mm-hmm.
building that portfolio of experience that you communicate to an investor to become a fund.
Yeah. What are some macro high level trends that you're seeing related to your holdings? Maybe you can talk through that. I mean, AI is definitely eating software when software was eating the world. So, and obviously we can't have a podcast without bringing up AI, right, Rick? But, any other top level trends or insights just kind of related to kind of what you guys review and analyze as you're kind of looking at investments and kind of looking at allocating.
Yeah, we're everything we do has some technology bent.
Mm-hmm.
Our software group is clearly technology. We talk about AI every day.
Sure.
All of our industrial and even healthcare holdings in our PE groups are technology enabled, or
Mm-hmm.
we are or making them that way. technology and AI is everything. One particular angle on AI that we're interested in, Joel, is this infrastructure investment in AI and data centers. Everyone is watching this now. Billions, hundreds of billions of dollars going into data centers, and this idea that we have an AI bubble. Well, one of the things that we're looking at is Bow River invented this concept 20 years ago that we invest in the rodeo region, which is basically the center of the country, 14 states in the middle of the country, from the plains to the mountains to Southwest. And I've been watching these data centers and semiconductor fabs being built in the last 3 to 5 years. More than half are being built in, quote, the rodeo region, Texas, Arizona, Utah, et cetera.
Sure.
And why is that? Well, part of it is land availability, of course, but part of it is the type of regulation and permitting that's required. You can get a permit for a data center in Texas in 2 years. In Virginia, it takes 7, and that kind of thing. And it's important. It's an important economic generator for the rodeo region, this AI build out. We are concerned about the bubble sort of ingredients there. We think that some of the debt positions are going to be troubled, but on the other hand, we think we're techno-optimists here. We're confident that AI is going to indeed be a new industrial revolution. Yes, we will overbuild some of this data center and stuff, but our real estate group is taking advantage of the significant investment in Texas, in Arizona, and Utah by building related real estate or owning real estate that benefits secondarily, tertiarily by those investments. So you mentioned AI. That's something that we are looking at, and it has risk, but it also has great upside, and it has some real geographic upside as well.
Yeah. And I mean, think about the demand that, we used to think about the electricians and the plumbers and kind of those type of roles as like, hey, it's blue collar, but you're going to have a shortage and get charged a premium now for finding a good electrician that can kind of set up these data centers, right? So I think there's a gold mine in those careers. And, I'm in New York, right? So there's plumbers and electricians and a lot of that blue collar work nobody wants to do, right? So there's a premium on that type of skill. And I think some type of educational platform that can help people accelerate kind of learning that trade, because you're going to need those literal hard skills to actually, build the infrastructure or find the right contractor to do it right, especially for processing the data, ingesting the data, and also just having, a lot of the electronics and infrastructure put in. And then I would say also when it comes to plumbing, I'm assuming just like the cooling systems and making sure all of the HVAC and cooling systems to just make sure none of those things overheat. So,
and you're seeing exactly that in, for example, Phoenix, TSMC building those giant semiconductor plants there. They are also investing heavily in 3 community colleges in the area to create curricula to develop the type of workers they want. And it's not all engineering. It is plumbing. It is water management. It is some of the basics. And so I think that the employers themselves are recognizing that they're going to have to not wait in some cases for the educational platform to do what it needs. And so they are accelerating that by their own investment. They're creating their own schools basically to create pipelines for the employees they know they're going to need.
Switching gears in terms of leadership and developing culture at a firm. Let's say this manager is now on his 2nd or 3rd fund. He's got to hire some more people because he's got more assets to deploy, right? So what's some advice that you've learned over probably over the last 20 years, right, with Bow River in terms of building culture, leadership, and teams, and also just motivating talent to join, but then also stay and grow with the firm?
It's an important subject because we obviously have been growing and adding to our staff, and how we do that and where we find those people is all important to us. We're very careful about who we hire. We need to be. There is technical skill, but there's also a chemistry that goes along with the culture in our teams, and so finding those people is difficult. And I'm asked often, how do I study? What should I bring to your company? And of course, you need to bring technical skill. You need to bring competence, understanding numbers, being able to do those spreadsheets, understanding how businesses work or how real estate is valued, et cetera. All that technical competence are now table stakes, Joe.
Mm-hmm.
What I look for and what our MDs are now looking for really is more of a well-rounded candidate, someone who really understands the macro side of things, who understands, as we were talking about, economic conditions and how they may affect buy, sell, or debt positions.
Mm-hmm.
We want someone who is, frankly, a very good communicator. And we sometimes have difficulty with that. Many students come out of school very, very good with spreadsheets and numbers, but not as good at communication. And we need someone who can not only understand the numbers, but communicate those and persuade others that they're right. And so these communication skills are important. The importance of psychology, something I learned along the way in my career, back to that, is all important. Everything having to do with performance at some point in time has to do with interpersonal relationships, being able to manage people, being managed by other people, persuading and leading. All of that has to do with personal interrelationships and psychology. And so some of that can be taught, but some of that has to be learned, I think, just by experience. But I think that students need to be a little more aware, explicitly aware of those interactions they have with their friends, their colleagues, their early business relationships in terms of how they're working, because you can be the spreadsheet king of the world, but if you can't communicate the results of that, it isn't effective.
Yeah, no, I totally agree. I mean, I think communication, confidence, those things are really important. You know, a lot of us have nerves when we have to do public speaking, but you mentioned this earlier, you know, you get comfortable by being uncomfortable. The more of these talks that you give, the more of these, I mean, these podcasts have been really helpful for me in my confidence building, but just kind of getting out there, not only communicating, but, you know, cascading that communication over to leadership. You know, I don't know what your reaction is, and obviously, you know, Ray Dalio is kind of retiring now, but his leadership style, I mean, some of the things that I appreciated about his leadership style was the ability for, there's obviously a lot of other concerns that people had in general with his leadership style, but one thing was, you know, being comfortable to actually share your opinion with your manager, right? And being able to have some type of transparency and be able to have that communication. And sometimes you do have to manage up. You know, you might be micromanaged and your manager may be cowering over you, kind of, you know, checking on everything that you're doing. But, you know, that's going to create more work. That's going to slow things down versus enabling people to kind of have some agency and ownership and control of kind of some project, you know, whether it's managing you know, one of the fund structures that you guys have and kind of having an incremental role in that. I think that's kind of a great way to kind of build leadership and obviously like get retention, right? Have these people have, you know, be aligned with the mission and the bigger picture where the firm is going. But, you know, I wonder what your thoughts are in terms of like some different leadership styles that you've observed and maybe adopted portions of them from different asset managers as they evolve and grow and obviously scale themselves.
Everyone has their own leadership style. Mine is talk softly, but carry a lot of knowledge with me. And so I'd like to think that when I do speak, which is infrequently, people do listen because it's typically on point and I do have a point of view. If you're not managing up, Joel, you don't have probably a career ahead of you. You have to be aware of managing a side, down, and up as well.
Yeah.
This idea of, I mean, leadership has to be, in my view, equal parts of competence, humility, and transparency. I mean, you have to be respected for what you know and what you can do, but you also need to be respected for what you admit as your failures,
Yeah.
and I think the humility is missing in many leaders. I think
Sure.
and I think there is a sense that respect comes from authoritarianism, and it really, I think, comes from vulnerability sometimes. And you said something a minute ago, which is all important, is you have to, in your firm, invite your people to have a point of view. Don't just go with the consensus. And important with that point of view, tell us what your point of view is ask the question that everyone is thinking, but no one is asking. Be courageous enough to say that. Now have thought through what the answer might be so that you can respond to the next question. But you've also got to be willing to change your mind when the facts change, as John Maynard Keynes said. But it's important to have a point of view, be recognized as an expert in certain fields, not in all fields, but some of them,
Sure.
and really focus on not always being right at the same time, but getting better.
Yeah.
And so, yes, you want to be right, but you can't be afraid to be wrong en route to getting better. And that has, this transparency and humility elements that are important to leadership, but they're important to all levels of any organization.
What would be some, on the flip side, what would be some pieces of advice for institutional LPs as they're kind of building their portfolio construction? What should they think about when they're taking a chance on a new manager versus just continuing to re-up? Obviously, there's the track record, the data, but you still have to choose, right? And sometimes, I'll be honest, some of these managers, they all look the same after a while. So how do you really, think through that allocation process? And then obviously there's allocation cycles for each institution. And maybe you can talk through a couple different personas, right? There's foundations, there's institutional single family offices, there's obviously fund of funds, which obviously have their own portfolio construction, and LPs they have to deal with as well. So maybe just, top level highlights on just kind of the LP perspective and how they can be better LPs.
One reason that Bow River has not to date focused on top tier institutions, pension funds, is for the following reason: is I think that, as you say, it's really difficult to understand how a manager is going to do. You can look at track record performance, you understand how they've done, but to understand an advisory shop like Bow River or one like us, you need to understand the people. You need to have a discussion like we're having today in terms of what is the culture of the firm, what is your investment process, what happens when things go wrong, all of that. The largest institutions allocating great deals of money don't really have the time, even through their consultants, to understand those smaller advisors. And so we have focused on large family offices and other smaller institutions who take the time to get beyond our performance. Yes, our top tier performance in a number of our funds has given us access to entry to their thinking, but our best investors are the ones who understand us the best, who get to know us. We get to know them. It's a true partnership, which is overdone in our world, but we do all of our fundraising internally. All of our investor relations are done internally at Bow River, and we do that very intentionally. We do that because we want to understand our investors, and we want them to understand us. And so we develop relationships. We're talking with investors that may not invest with us for 5 years, but we want to know them. We want them to watch us. They have access to us in terms of our investment committees and the way we're thinking, how we change our thinking. And so we are comfortable in that world of not dealing with the large allocation assignments, awards from the largest. We're willing to work for some of the smaller institutions that we think gain respect and confidence more directly.
What about, you touched on, in your past life, kind of doing a lot of work cross border, working with businesses in China and, several other, geographic regions. What have you seen has evolved internationally, with a lot of the LP and GP ecosystem building. I know there was a whole push for, just across the globe, sustainability and impact. And, I've seen a lot of that go away in the US. Some of the, we run like a fund accelerator, and we've had a handful of climate funds that have shared that there's definitely challenges in the current ecosystem. And some of them have also mentioned that they've had to kind of change their messaging, to not say impact or say sustainability, and maybe just kind of really think through the branding. And that's common too. You talked about messaging earlier, right? So trying to really think through how people can understand your product. I do still see a lot of infrastructure investments in both the Middle East and in Europe. But, we'd love to hear any other trends of color across the board, whether it's, software or technology in other regions that maybe you engage with.
We are U.S. focused investors. We have done some work in Canada, but we do keep abreast of what's going on out in the world. We do have interest from foreign investors in Bow River. They like exposure to the U.S., and they especially like exposure to the rodeo region. You are implying that things have changed in the United States in the past year. That's very much true. We're seeing a good deal of my colleagues outside of Bow River are still quite interested in investing in Europe, in Latin America. We're seeing more hesitation from the investors there to come into the United States because they don't quite understand the policies that they're seeing right now. And so there is a bit of a seismic shift in terms of international investment flows. I think it will settle over the next few years as some of the unknowns, trade and economy settle. But it's our focus is, Joel, all U.S. for the most part, and so we're relatively sanguine. I'm relatively sanguine about the U.S. economy. It's fashionable these days to be looking for the next recession, although in my long career it's always fashionable. But we don't see it ahead, and there are a number of reasons for that. Some of it is this business investment in AI we were talking about. The consumer is, at least at the top of the K economy, still fine. I think the jobs report that comes out this week, delayed, is going to show that employment growth is moving up again, not spectacularly, but I think it's going to be stronger. And so I think in the next few weeks, months, people are going to see a stronger American economy than maybe consensus right now. But we were having a discussion yesterday, Joel, that's relevant to this. I worry a bit about the fact that we have had this long period of time without a recession, excusing COVID, which was very specific, but downturns are sometimes healthy. And we have not really seen one since, in 15 years. And maybe a third of the American workforce has not participated in any sort of real economic downturn. How does that affect investing? I mean, there is this sense, and I have friends who will tell me that they believe that much of what we see in front of us in the economy is too big to fail. And so we can capitalize gains, but socialize losses. There's going to be a bailout if something happens. And I worry what happens to investment theory and investment activity if there isn't a proper assessment of risk ahead. And so that is one thing that we're worrying about a bit, is the fact that things are too good.
You're wondering when is it gonna pop? But I think, look, it's also, in my opinion, it's just your perspective, because the wealth is really created during a recession, right? You're not going to get huge alpha when everything is up and to the right, but you could get bigger alpha when you come in at the right time. And I remember with COVID, that was one of the biggest years for IPOs. I think Slack IPO'd, Airbnb IPO'd. So when you think about your perspective, if you're trying to get in and have a higher multiple, you want to buy low and sell high, theoretically, right? Obviously with some caveats around that, but you want to, that hopefully there's dry powder where you can allocate when that time happens. We got about a minute left, Rick. So I always ask this at the end of the show. just a piece of wisdom. It could be from a family member that maybe just has a quote that's barked on that you hear in the background every once in a while, and it keeps coming back to you. Or it could just be one of your colleagues or a mentor, but just one piece of advice, one piece of wisdom, just kind of reflecting on, your career that you want to take away with us.
Two things come to mind, Joel. Two simple thoughts. Number one is always maintain your curiosity and follow through with that, meaning don't be afraid to learn something new. Don't be afraid to be uncomfortable. And if you allow that to guide your career, you'll find that being in a trajectory that's not a straight line is actually quite comfortable. So that was first. And the second is a very simple one, but one of my mentors always, in situations where we saw conflict, we saw adversity, he would say, do the right thing. And it was a sort of a cowboy ethics statement that seems simple, but the right thing for us at Bow River, and for me, has always been protect your investor, do the right thing for them in every case. And so it comes back to the ethics of investing, which also involves everything else we've talked about: humility, competence, etc. It all is wrapped into doing the right thing.
Sure. Well, hey, Rick, thank you so much for being so generous with your time and sharing and dropping all this knowledge and stories and insights. Our audience is going to really appreciate it, along with me. And hope you have a good rest of the week, along with everybody else that joined.
Thanks much, Joe. Enjoyed it.
Take care. Bye.